Now that we've learned how to prepare adjusting journal entries and we have finished the adjustment step in the accounting cycle, the next step for us is to prepare the adjusted trial balance. So let's take a look at the adjusted trial balance. The adjusted trial balance is prepared after all adjusting journal entries have been posted to the ledger and all the accounts now are at their correct balances. This trial balance is a good trial balance, and so we can use this trial balance to prepare our financial statements because they will have the correct balances. And so we will pick up revenues and expenses to prepare the income statement. We will pick up the assets and liabilities and equity to prepare the balance sheet because all the accounts are at their correct balances. So we are going to take another look at financial statements here. You will notice that we have an income statement which looks kind of larger than what we had seen it in chapter 1. So we have more than one revenue now. We have two revenues, and then we have several expenses. And part of the expenses is depreciation expense, what we hadn't seen earlier. So we add up the total revenues, add up the total expenses, subtract expenses from the revenues, and we get net income. Then this net income gets transferred over to the statement of retained earnings, and we get the ending balance of the statement of retained earnings. Now we are ready to prepare a balance sheet. But this balance sheet looks different from the balance sheet we saw in chapter 1, which was divided into two halves, kind of like the accounting equation. That format of the balance sheet was the account form. This format of the balance sheet is referred to as the report form because all the items are listed one below the other. So assets are listed first and then liabilities follow that, and then we have equity following that. Even though this is a different format, we still follow the same rule where total assets will equal total liabilities and equity. So this is also a classified format of a balance sheet where your assets are divided up into current and non-current, and your liabilities are divided up into current and long-term. So what are current assets and non-current assets? Current assets are assets such as cash and other assets that can be converted to cash within a period of 1 year or one operating cycle, whichever is longer. So examples are cash, accounts receivables, supplies, prepaid accounts. All these are current assets. Non-current assets are assets which have lives beyond a period of 1 year or one operating cycle. And in that category, we have long-term investments, we have plant assets, and we have intangible assets. We are not going to be covering long-term investments in this course, but we will talk about plant assets and intangible assets in a great lot of depth in chapter 8. Examples of plant assets are assets such as building, equipment, the ones that we depreciate. The adjusting journal entry you saw earlier related to plant assets that are depreciated. And so we're going to take a detailed look at plant assets. Moving to liabilities and equity, liabilities are broken down into current and non-current. Current liabilities are liabilities that have to be paid off within a period of 1 year or one operating cycle, whichever is longer. And so accounts payable, unearned revenues, wages payable, all these are items which are classified as current liabilities. And non-current liabilities essentially are long-term liabilities such as a long-term loan or a note payable which is due beyond a period of 1 year. So this is how we categorize current and non-current. Once financial statements are prepared, accountants never take a break. So we need to get ready for the next accounting period. And it is kind of like clearing out our desk so we are ready for the next accounting period, next year, next month. We go through a closing process to help us get ready for the next accounting period. So what exactly do we mean by closing? We have two types of accounts. We have temporary accounts and we have permanent accounts. Temporary or nominal accounts are accounts that exist for just one accounting period. These accounts are your income statement accounts, such as your revenues and expenses, and then your dividend account, and then another new account called income summary, which we are going to be discussing. These accounts should exist for just one accounting period, and at the end of that accounting period, they need to be cleared out, zeroed out, so that they have no balance in them, so that when the next accounting period begins, they will have balances related to just that accounting period, and there will be no data from the prior accounting period. The other type of accounts are permanent or real accounts. These accounts exist one period after the next. Their balances roll over from one period to the next. And examples of these accounts, permanent or real accounts, are asset accounts, liability accounts, common stock, and retained earnings. These accounts carry over their balances into the next accounting period and are not closed. So we have to go through the closing process to close out temporary or nominal accounts. Closing accounts involves preparing closing journal entries, and we have a 4-step process. We first close out revenue accounts. Next, we close out expense accounts. After that, we close out the income summary account, and then we close out the dividend account. So it's a 4-step process. Graphically, here is how closing works. We have revenues and we have expenses, and we transfer the balances of the revenue accounts and the expense accounts to a temporary account called income summary. This is a temporary account that exists only during the closing process. Once we have transferred the balances of revenues and expenses to income summary, the balance in income summary then represents net income. So we are going to close out the income summary account to retained earnings, which essentially means that we are transferring net income to retained earnings. And we saw that happen in the statement of retained earnings, but that was not formally journalized. So this is where we record that in the form of a journal entry, where we transfer net income to retained earnings. The last step is to close out the dividend account, and we close out the dividend account to retained earnings. And once again, we saw that happen in the statement of retained earnings, where the dividends were deducted out of retained earnings. And so this is where we formalize that process through a journal entry. So what I'd like for you to do now is look at the video for the closing entries example that I have walked you through, that shows you how closing entries are prepared.